To the May Fireside chat. Welcome back, Chris, after Jaden filled in admirably for you last month.
Thanks, Clint. Good to be back.
Obviously, there's been a little bit happening over the last little bit that you missed. So I thought we might start throwing over to you just to give us a bit of an economic update and some interesting things you're seeing in your part of the world.
Cool. Thanks, Clint. Good to speak to everybody again. Look, the thing that's front and center at the moment is obviously the Iran war with regard to the impasse that both countries, or all three countries, find themselves at the moment with negotiations, and obviously extension to ceasefires as well. So it seems like at the moment that they're further apart, and this week was no different. So negotiations called off multiple times. And then non-starters with regard to requirements and demands from both sides. So there's definitely risk arising regarding an elongated conflict with no resolution in sight. And the Strait of Hormuz, varying reports coming through, but remains blocked by both the Yanks and the Iranians to a certain degree as well, so complicating that. Oil price ratcheted higher this week off the back of some of that news. I think markets are sort of hoping at the back end of last week that we might be getting closer to a negotiation of some sorts. But the stalemate that we saw this week a few times meant that oil prices rocketed up higher again, particularly Brent crude, which is the European pricing for crude. We've seen that push significantly higher, and that is creating problems in markets. Where we're seeing that come through is in relation to inflation expectations. And then we had various inflation prints through the world over the last couple of days as well. And as we all imagine and know, inflation has definitely rocketed higher across all countries in relation to oil and gas price and transportation costs as they relate to. The second and third order effects of those higher oil and gas prices haven't yet shown up in inflation. So I mean, food prices and services prices. But the expectation, if you look at inflation expectation prints that came out this week, the expectations are that'll continue to rise through the course of the year. So creates a complicating headwind and issue for central banks in particular with regard to their rate path exercise. And markets at the moment appear to be a little confused as to how they digest that in the forward period.
Very good. And obviously, with the inflation expectation, it brings us back to the conditions where we first added gold. Gold is still well down from when Trumpy started dropping his bombs. So with that inflation expectation plus the ongoing high levels of debt in the Western world, it remains definitely a allocation that we recommend. And at these lower prices, if clients don't have it, it's probably an opportunity to make sure that clients have some sort of allocation to that at this point.
Yep, makes sense.
Yep. Additional to that, obviously, just give a bit of an update on the MBA transfer, that trade freeze, which includes being able to buy, sell shares and transfer funds out of the MDA. That started on the 17th of April. Expectation is up to 1 month. So that'll kick through till mid-May. However, speaking to them this week, they expect the actual transfer from Explore onto Hub to occur over this weekend. And login details and being able to view it on Hub likely to be available by next Friday. So fingers crossed that gets lifted as soon as possible. Given the trade freeze was on after last month's main investment committee meeting, we weren't able to do any changes, so there was no changes from there. Just thought I'd touch on a couple of other points. Ben, you brought up the amount of cash in some portfolios, including infrastructure last month. One thing I forgot to mention was specifically the infrastructure portfolio. We have the old AMP core infrastructure in there, now managed by Dexus. They made a decision last October to wind that fund up and terminate it. They've paid out about 50% of the funds to date. So those funds are sitting in infrastructure while we look for a replacement. We have got one in mind that we're just finishing some due diligence on. But at this point, the infrastructure does have some higher levels of cash than normal. In addition to that, Chris, I don't know if you have any more information on it, given it was suppressed by the courts for a fair while, was the APAC litigation around Dexus's behaviour in regard to sales of Melbourne Airport, of some of the funds, the units that they manage there. And I think you mentioned in the investment committee that it could be a long, drawn-out process for the balance of those funds to be paid out.
Yeah, look, it looks like based on the information at hand, and as you said, there's not much information being released given it is tied up in the court, so both sides being careful about what they release. But it's fair to say that as it currently stands, it looks like it'll be a long, drawn-out process, unfortunately, unless there's some resolution or negotiation or meeting in between somewhere. But yeah, drawn-out process in terms of the way it's likely to play out.
Okay. A little bit disappointing, but we'll work with that as we go. Obviously, we finished the March quarter now, and all the numbers have come through. Pretty much, those numbers were pretty good, notwithstanding there was some negatives overall in there. But pretty much every portfolio outside of the diversifieds have beaten their index, some by quite a substantial amount. And that includes also beating their index for the last 12 months as well. I think that harks back to some of the contrarian positions that we take, some of the non-correlated positions that we take, and just some of the other changes that we make. For example, Chris, probably mid to late last year, we made the decision, given Goodman's increased weighting in the index, and at that point in time, we had the Charter Hall a REIT fund, which was pretty much in line with the index, having very large allocation to Goodman's. We made the decision to exit that and go into MVA, which is the equal weight listed property ETF, which I think has shown quite resilience through this part, with the index falling about 16% through the March quarter, with the MVA listed property portfolio only being down about 11%. And if we expand that out to 1 year, the index being down about 2%, but the MBA portfolio being up 4%. So there's some significant differences in that portfolio. I think that was a good call to exit that position, Chris.
Yeah, no, I agree. The ARE market, as many of you on the call will know, is dominated by Goodman's. I mean, the stock is now almost 40% of the index. So when you are holding an index or index relative position in REITs in Australia, you're going to get a big whopping exposure to Goodman. Goodman's a great quality company, no doubting that, and should do well going forward. But it will dominate returns in that exposure, and you sort of count back to why we have REITs in a portfolio. We want them there for diversification and for the addition of some yield. And so when one stock is almost 40% of that exposure and offers very little yield, you don't get those two aspects with regard to that allocation. So the benefit of market vectors in the portfolio is, as you mentioned, an equal weighted approach. And so the benefit of that is that Goodman gets REIT scaled down pretty aggressively, and the other stocks get an uplift. And so you're largely getting an exposure that is more truer to property exposure, so rent collecting, property enhancement, that sort of thing, which is what we want from the exposure. And that has definitely held up better over the last 12 months versus a Goodman heavy index.
Yep. I won't go through all the portfolios. That information's available for everyone. One other one, though, I did note was international income. It was positive about 4% versus the index down about 6% for the period. So our performance there in that international space by about 10%. Primary drivers of that just being some of the different sort of positions we take there was the Clearbridge Infrastructure Fund that was up about 11% for the quarter, and the GQG Partners Global Quality Dividend Fund, Dividend Income Fund, which was one that you suggested in there, Chris, and that one's performed quite well. And is that in relation to, as you've flagged before, GQG making that big bet on AI just going to run into some headwinds at some point?
Yeah, it is. Yeah, so GQD, as I think we've mentioned before, has been very contrarianly positioned in their portfolios for the better part of about 12 months. And the main issue there is they've obviously taken their exposure to tech down to almost zero across their portfolios from being overweight previously. And in benefit of hindsight, they moved too early. They freely admit that today. But that portfolio and across their other portfolios has actually paid off come to fruition in the last month or two. So performance has been strong across the board. And that the strategy you mentioned specifically has a bit of a value income bias as well. So, and the benefit of that in the last 12 months is value stocks and income stocks have caught a bit of a bid, which is great to see. Been a long time in the wilderness for value stocks and income stocks in global equity investing. So it's great to see them come back into into the limelight, and investors pivoting and paying attention to a broader remit of stocks than just US tech stocks.
Yeah, they definitely had a good performance. And I'll just make note of the Australian Share Direct Core portfolio that you guys have large hand in selection of the investments there. Outperformed over the quarter by about 3%, but the big one there was the 1 year numbers. It's outperformed by about 10%. So is well done on that one, Chris and Jaden.
Thank you.
Have you
Was the case with stock selection. So
Yeah, that's good. And I think there's a couple of changes upcoming in that one once that we've already flagged once the trade freeze is lifted. So we'll be in touch with Jaden to get those underway at that point. Only other main thing here, I guess there's a couple of once the trade freeze is lifted, we're only going to be a month and a half off into financial year. So any changes that need to be happened, if there's longer dated settlement investments in there, everyone's going to need to be aware to get those up and running. Two that we are aware of that are causing some issues for people that want to close self-managed super funds is the Millbrook Mermaid Beach one. It's due to mature in June. We've already spoken to Millbrook about that one, and they're happy to facilitate people that need to get out prior to 30 June if it looks like any sort of extension on that one. And the DFS mortgage fund as well is another one that's just been delayed from February to March. We're hoping for an update mid-May on that one, and then we'll be in touch with people that have clients that are looking at exiting for a solution to that one before 30 June. Any questions on any of that, just get in touch with me and we'll go through that one in a bit more depth. I have nothing else, Chris. Is there anything else that you found of interest that you want to touch on at this point, or we'll open it up for questions?
no, I think the only thing to sort of finish up on is just we've been monitoring how the markets have sort of fared and how they've traded news flow over the last probably 4 to 6 weeks in terms of the war, and it's been interesting to watch as we get these episodic versions of risk in market as they pertain to different things. It's been interesting to watch how the market takes them under their stride and then reacts to them and then pivots on. And they're good learning experiences. I mean, a lot of the time it's hard to make sense of what's happening in the market, but it's fair to say if you look at the last week or so with regard to US earnings coming through, we're back to a very narrow market rallying in US tech stocks again. So it's I thought we'd moved on from that, but we're back to doing that all over again. So it is worth just noting that when you do see some of the returns over the last couple of weeks, they will be dominated by a very narrow subset of stocks yet again. So interesting to see that the market had started to broaden out in terms of its winners, in terms of depth and breadth, and it seems to have now narrowed right back again in relation to I guess concerns around the potential end of the war or the lack of end to the war. So just interesting to watch and something we're monitoring closely in portfolios.
Exactly. All right. If anyone's got any questions, put your hand up and we'll go through those. But otherwise, thanks, Chris.
Thanks, great.